When people hear the word credit, they often think of a mortgage, a bank or student loan, or credit cards. A better, more general way to define and understand the concept of credit is when one party receives resources from another party, but for which there is no immediate payment. In the case of a bank loan, the resource received is cash, or the availability of cash by way of a credit line or a credit card. But there is also something called trade credit. With trade credit, the resource received is a product or a service for which an invoice is issued with an expectation of future cash payment per the invoice terms. The party that receives resources is the debtor, often called the borrower if it's a loan. The party that provides the resource is the creditor, or a lender if we're talking about cash credit from, say, a bank. Creditors employ a variety of risk models and frameworks to measure credit risk prior to advancing resources to a debtor. They then employ creative credit structures to help mitigate loan loss should an event of default occur. These include characteristics like the maximum loan amount, the interest term, and the amortization period. Another big one is collateral. When it comes to bank loans, particularly for commercial borrowers, it's often to finance or to refinance a physical asset, like a property, a vehicle, or equipment. This asset serves as collateral for the loan, so it's said to be secured credit. Credit that is not secured by a specific underlying asset is said to be unsecured. A good example is consumer credit, which includes student loans and credit cards.